Hi guys, welcome back to TETrading and another YouTube video talking today about how you should be investing and looking to invest in your later years. I had a very interesting conversation at the weekend with the family, and this video is actually dedicated to my mum, which is very sad. But we spoke about getting into the stock market in sort of the later years, how you do it, what you should be looking at and getting into, and there's a few things I'd like to cover off with you in this video, and hopefully it helps some of you, maybe not all of you, but some of you. So we've opened with my portfolio as always, a complete transparent look at the portfolio, but I'll put up on this side of the screen just a list of kind of what I want to talk about to begin with when investing in your later years. You're looking 50, 60, 70 years old. If you've got a lump sum of money and you want to be getting something back from it, and savings accounts are giving you minimal amount of return, this is what I would look to do with it. So there's a few things I'll cover off in this video. First one, I'll ping it up there. First things first is, I imagine if you're 50, 60, 70 years old, you've probably got this under control already, but you need to be getting debt under control. You need to have really absolutely no debt. Clear off your debt first. That's going to be the most expensive thing really when you're getting into later life as well. Get your debt cleared off completely first, and then start looking at investing your money and putting into the stock market. But the main thing is getting the debt cleared off first. Quite often if you've got a loan, big loans or mortgages and things like that, you're working on quite high percentages interest rates. Certainly loans in the UK at the moment, the best you'll get is 3.5%, 3.3. So if you've got loans and things like that, you need to be looking at clearing those off first. This goes for anybody really investing. Try and get your loans and your debt cleared down as much as you can, but certainly more so in later years. Get your debt cleared off, paid off, paid right down to either a very, very low level or completely, which a lot of people that this video is, the audience this video is aimed at, is going to have that all under control already, I would have thought. The second thing is, again, as with any kind of investing, really important, again I'll pick it up there, is having an emergency fund. So it's very important to have an emergency fund in place just in case you've got some money there to use if anything was to go wrong. At any point suddenly the boiler breaks down, you've got a few grand to plow into that and get that sorted out. So emergency fund is very important. So the other thing, or really the main message in this video, is going to be building a portfolio that's going to pay you back either some good high or reasonably high dividend paying stocks, but some solid blue chip companies who are sector leaders and are going to are almost recession proof. I'll ping a video up, or tag a video up at the top there that talks about sort of building a recession proof portfolio, but you want to do almost a similar thing. So you want a very defensive portfolio when you're later in life. You're probably at the point where you haven't really got time to start clawing back any money that might have been lost by going into more risky speculative plays. So let's get into some less risky, less speculative plays and build a very defensive portfolio. So what we're going to aim for, and I'll run through a couple here actually. I've got Seeking Alpha up again. So what we're really going to aim for in this portfolio is a couple of things. One, high dividend paying portfolio, or higher dividend. We don't want to be going monster dividends because they're not as safe, but in and around the 3%, 4%. There's some fantastic companies out there that'll pay a 3 and 4% dividend in blue chip stocks and companies. So that's one way of going about it, and we'll go through maybe one or two on here. And the other thing would be following the 4% rule and looking for capital capital growth really, which you want to be a value investor or go down the ETF route. So first things first, let's look at something like Walmart. I had this as my recession-proof portfolio. This is going to be a great company to get into to build a portfolio that is, first of all, blue chip. Second of all, consumer staples. It's in the sector, again, it's in my recession-proof portfolio video. The sector that's going to be more resistant to the bad times. You're always going to need the kind of things that Walmart are selling, no matter what's going on in the world. So that's sort of a first example that would be a great company to get into, Walmart. So hopefully you can see this. I'm not right in the way. I may well be in the way. But we've got a little yield here. We've got a 1.58% yield. We've got a PE ratio of 25, but a solid company. 388 billion market cap, absolutely huge. One of the sector leaders really in what they do. So a real solid, safe company to be getting your money into. And Walmart, over time, has slowly but surely, as you can see there, has grown. In which case, you may well also be able to apply the 4% rule, which I'll talk about in a minute, to this as well. So something like Walmart, something like one of my favourites always is Johnson & Johnson. I talk about this all the time. So again, the kind of company that if I go into Max here, time period, has done nothing really but go up. A few dips here and there, but in time, it's gone up. It's paying a 2.75% yield. It's got an 18.71 PE ratio at the moment, so not looking too bad value really. But Johnson & Johnson been paying dividends forever. So these are a couple of examples that you could use to build a portfolio that is going to pay you on a monthly basis. So you're going to be, not monthly, quarterly basis. So you're going to be getting some return from it, but also companies that you may well be able to apply that 4% rule that should over time just continue to kind of grow, because they're such big companies that they're so well diverse and they're so well established. So these are going to be low risk, nothing speculative. These guys have been around and doing the same thing for forever and ever. We know they're big companies, we know they're good quality companies, we know they're always going to do pretty well. Setting aside a complete disaster within the company, which may or you never know, might happen. That there's risk with anything. Getting into the stock market is always a risk. My thought process is having your money in a bank account that is paying 0.5% interest is more risky, with inflation being a minimum of 1%, generally 2%. Each year you're actually losing money. So this poses less risk than that, than having it in a bank. So consumer staples, something you want to be getting into really, because it's always going to be needed. It's a sector that's always going to be in demand no matter what's really happening in the world. You want to be getting into well-established, big market cap, blue chip companies which are sector leaders. They've been around forever. They've been doing the same thing forever. They're not speculative plays like get into Tesla when it was $100 because now it's 2,000 pre-split. But we're getting into companies that are just very boring. In fact, these are incredibly boring companies to be getting into, but they're just solid, good investments over time. So nothing fancy here, nothing fancy at all, but good, hopefully good, solid advice. And this, by the way, is just what I would do if I had a big lump sum of money when I was 60 and I was retiring. So the other thing we can look at is, and another way of drawing money from the stock market and from your funds, is the 4% rule. I've talked about this in another video, but essentially what this means is the stock market as a whole, and let's follow the S&P 500, the top 500 companies in America. The S&P 500, the stock market, has typically returned just over 9% on average a year. So and that's not including dividends. If you go into a fund like the one I was about to show you, they'll pay a 1.8% dividend as well. So what that essentially means is you can quite comfortably, or you should quite comfortably, be able to siphon off slithers of your portfolio every year, 4%, 4%, 4%, because on average the S&P 500, the overall stock market, will return. History repeats itself, so it should return 8, 9, up to 10% every single year. And let's say that it only returns a 5-6% return one year, or on average across 5 years it's down 1 year, then it's up a little bit, down, and then hugely up. But let's say on average it only returns 5%, and we're being really conservative. Your 4% rule, you're only taking 4% of your portfolio, it's still going to grow. So that's essentially the 4% rule. Slivers of your portfolio, 4% each year, you live off that, and that helps to fund your lifestyle as well as any retirement plans you've got. Your portfolio is unaffected, your capital remains intact, if not growing. Okay, so let's go for my old favourite. I'll show you just one. Vanguard. Vanguard do a fantastic S&P 500 ETF, and they pay a 1.75% dividend yield, so you will get your income. In fact, I've just received dividends from Vanguard's REIT ETF and their total stock market ETF, ticker symbol VTI. So you'll still get the returns, but on average it has returned 9.6. I don't know. You can comment below, correct me on that. What's the stock market or the S&P 500 returned since inception? I think it's around the 9% level. Whether that may or may not be including dividends, I'm not sure. But I'm sure it's just capital is 9%, around 9%, just over. So it's returned just over 9% a year since inception. So you can quite comfortably and diversify this. So go Vanguard S&P 500 ETF, Vanguard total stock market, emerging markets, high dividend yield. They've got plenty of different ETFs, so you can even diversify across the ETFs if you're going to go for this 4% rule. But what that essentially means is you're still going to get your small dividend yield, maybe not as much as something like your Johnson & Johnson, your Procter & Gamble, your Coca-Cola, your blue chips. But what it does mean is that you can siphon off with a bit more confidence your 4% each month, and then allocate that to your living costs and your living funds, and your capital should not then be affected because the stock market has already gone up by that much. Now, there's always going to be years where it comes down. It doesn't, as it happens. In this year, it's still up, but there's always going to be years where the stock market is down. You still siphon off your 4%. You don't take it because the stock market's down and you've lost 2-3% in your portfolio. You still siphon that off. You still take that. You deserve that, because in the long run, over time, your capital is still gonna remain, because the market will then go back up again. If it doesn't and the market crashes completely for years and years and years, let's face it, you're not even going to be watching this video, so it doesn't matter. But anyway, that's essentially what I would do if I had a big lump sum of money when I was 60, right at the end. Not at the end, but once I've retired, I'd be going probably into some reasonably generous dividend paying ETFs that will follow the market, pay me a small amount each month, and this is relatively risk free. I'm not going into big bullish plays, speculative. I think Apple's going to do amazing, and suddenly it crashes and burns. So I'm going to diversify my money and do it that way. You can, of course, do both. You can put half your money into some ETFs and half your money, or say 60-40, 70-30, and your smaller amount, I would say, into your individual stock plays, your Procter & Gamble, your Johnson & Johnson, your Coca-Cola, your Walmarts and things like that. So that's it for today, guys. Thought I'd just quickly run through my thoughts and certainly what I would be doing if I was investing in my later years. Hopefully that's helped some of you out there, probably not all of you, in fact most of you probably got incredibly bored by that because you're not at that point. But hopefully that was useful for some of you. If you have found it useful, click the like button, that really helps. Subscribe if you haven't subscribed, because most people watching these videos don't subscribe. There'll be plenty more coming, so do that now. Good, and I'll catch you guys in the next video. See you later.